Yeah.
Here we go. Hello, everybody. Welcome to your Tuesday edition of the TraderMerlin Show. My name is Merlin Rothfeld. Happy to have you all with us today on a little bit of a pain point day. It's funny, on days like this, I always get messages from people freaking out saying, oh no, the markets are tanking. What should I do? What should I do? The answer is pretty simple. Just relax. You'll be fine. We'll get through it. Today, we're going to do a little bit of a different approach, though. Today, we're going to talk about kind of the longer-term aspects of the markets. Protecting or portfolio protection for 2022 is the topic of discussion. Joining me from the East Coast, we've got Mr. Justin Krebs joining us. Justin, how are you doing today?
What's up, Merlin? Good to be back.
Good to be back. After 9 months, we were joking before the show. I said, it's last time you were on was April 1st of 2020, and I said you could have had a kid in that amount of time, and lo and behold, you did.
I did, yeah. Little Aspen IVJ.
Well, Aspen, nice. So at this point, are you buying a giant shoe to live in? Because, how many kids you got now?
We have 5 now.
Holy goodness gracious, 5 children.
Yeah.
And I have a German Shepherd.
Well, it's kids dogs are like kids, right?
Are they?
No.
I was going to say, not even close. Nice. Well, today, as we mentioned, guys, we'll be looking at kind of the longer-term aspects of the market. But since it's been almost a year since I've had you on the show, tell me a little bit about what you've been up to, what's going on in your world, and how's the managing money market going?
Yeah, it's obviously other than the family, the proactive investor, my firm that I started, it's been doing really well. But it is, we kind of mentioned a little bit, before we talked on the show. It's a whole different ballgame. When you are managing other people's money, you're managing large sums of money, and not just doing it yourself and getting in and out and having the versatility that you have as an individual trader. Even if you have a large amount of money, it's a whole different ballgame when you're thinking about other people's money, and especially those that are nearing retirement or getting to that stage where they're in their 50s and stuff like that, and they're thinking about okay, what do I do now? I got to retirement now. Now what do I do? So it's a different ball. It's a different animal altogether. So.
One of the things that I've drive home a lot and say a lot, and maybe it pisses some people off a lot, which is fine, it's okay, is, at this moment in time, from that rally we had in 2009 through where we are till today, colossal gains. And, I know where my portfolio stands. I'm sure each individual person knows where their portfolio stands, but you have a lot of people, I'm assuming, who have massive paper profits. Like they're sitting on a mountain of cash because they've been holding, and because most investors are buy and hold investors. What do you tell them, or how do you kind of set them up for that point that, listen, this is not going to be rosy forever. There's going to be some times where we're going to have to be very defensive, or you could give back a good portion of this portfolio if things really do go south in a hurry.
That's the tough part. You can tell people that, and I think they shake their heads. I'm like, yeah, I get it, but they don't get it. They really don't get it until they experience it. And that's what's really difficult. I've actually acquired all these, I've acquired all my clients with money, with the market sitting at or near all-time highs. So, the trader in me is going, I don't know, I want to buy high right now. But the investor in me is going, well, you have to, right? These folks are expecting some kind of gain. The market's up 15% since April. You've got to be in that ballpark, in that neighborhood. So that's what's hard. So it's just thinking of a better approach, basically, because really, we can go down this route if you want to. You can't manage money unless you're a huge hedge fund with all kinds of additional tools and skill sets. You just can't manage money on the level like as an individual trader, and that's where I feel that I really struggled when I started this, is because I was trying to time the market just like I time my futures trading, just like I time my Forex trades and stuff like that. And while you can, to a degree, the available tools for you at this level just aren't there. They're advisors. I'm telling you, I'm not kidding you. I literally had a conversation with, and I won't name the the custodian. But I had a conversation with them, and they just point blank said, you are, we can count on one hand how many advisors actually manage their own accounts in the way that you're trying to manage it. And, that kind of was a revelation to me. I'm like, oh, okay, well, I've got to approach it a little bit differently. So
absolutely. I mean, for you and I, if we're in that situation, we have such agility because most likely our portfolios aren't in the, the $100 million category, that it's like navigating a zodiac down a narrow river. Like I can spin around real quick where, you get to the level where I don't know the assets under management you have, but you start to get into millions and millions of dollars, get into hundreds of millions. You're trying to spin around a cruise ship in a really narrow river. It's like really, really hard to do. And it's funny because I've been asked countless times, and I know as an instructor, we get it all the time as instructors, when we teach that, hey, can you manage my money for me? I have zero interest on multiple fronts. Number one, I like to be responsible for my own stuff. And number two, I don't want to have my phone ring in all hours of the morning when some guy goes, hey, man, Euro futures are down 6%. I'm freaking out, man. What are we going to do with my portfolio? It's like, okay, I don't want any of that. Are you ready for it? Because it's coming.
Yeah. No, everybody, every single one of my clients actually has my cell phone number. I think that was a bold move to begin with. But,
yeah, I do too.
Yeah. But I mean, it is like kind of, you mentioned some of it is actually setting expectations. A lot of the folks that I'm dealing with, that when I first sit down and talk with them, I help them to understand, like, look, I mean, we're 11 years, the longest bull market run in history. I mean, this is the most overvalued stock market, in my lifetime and of all time. So, you have that expectation that we're going to have a drop. And I remind them, I'm not the type of advisor that's going to just sit through the drop. I'm going to actively get you out. And, hopefully if it gets down if it gets down a bunch and there's a recognizable buying opportunity, then yeah, we'll get back in. But I'm not the person that's going to sit through and be like, hey, I know you're down 30%, but it's okay. It'll come back. The market always comes back. Right. So it is having that conversation and setting a bit of that expectations. But yeah, I mean, so far so good. So
yeah, well, I mean, like I say, it's been a pretty nice rosy market for you to work with as well. Margaret has a question, which I think a lot of people may ask, is, as a fiduciary, which you are a fiduciary, right? I mean, you are now licensed and responsible for these clients and do the right thing. Yep. Can you actually go out there and short? Because I think a lot of people have this perception that fund managers or financial advisors cannot be shorting the market. Can you?
So that's a funny question. So under the current arrangement that I had, I was unable to do a lot of the things that I wanted to do. Since then, in the last couple of months, I've actually entered into an agreement with a law firm to take me and register me as my own registered investment advisory firm, which means as long as I pay a certain amount of insurance and, go through the regulations, all that kind of stuff, I am permitted to do a whole bunch of things that other advisors just can't do, namely things like options and stuff of that nature, and get into certain investments that I normally wouldn't be able to get into. But the answer is, can I short? No. You can't short on this side of the equation at my current licensing and structure. So
right.
No. So basically what you have to do is you've got to figure out how to, ride the market down without going short the market. Mm-hmm. Which there's a lot of, obviously, I just mentioned them, options as a way to do that.
I was just going to say, what are some of those resources? Because I mean, the classic thing is, and I remember I worked for a financial planning firm, and a large part of what they were looking at was seasonality. They were looking at the classic sector rotation models, like, oh, well, okay, well, if markets are tanking, we'll put them in healthcare and utilities because that should be more resistant. But bottom line is, if the market drops 50%, it's not like healthcare and utilities are going to be spared any pain, right? They may drop, let's say, 30% and be less damaged, but they're still going down. So, those are the classic models, but options wasn't a factor for the firm that I was looking at. Maybe they just didn't make enough money on it, but they weren't using options at all.
Yeah. I mean, that's the thing. I mean, a lot of firms don't do things that can actually help their clients just because they don't get paid on them. So,
right.
Yeah. So, I mean, there's a variety of different ways. I mean, honestly, one is just, when dealing with certain age groups, just diversifying the portfolio better. I mean, honestly, most people out there, they look at the stock market and they have all their eggs in that basket, which is fine when you're 20, 30, 40, maybe even early 50s. But obviously, you have to adapt your portfolio and diversify properly. So, I have a certain amount with my clients that I have I have my own models that I build, my own portfolios that I build, and I might have, say, right now I might have 60% of that in a model that outperforms the S&P pretty well because I've got some really good stocks in there. So that portion will outperform the S&P, but then I've got 20% in, say, REITs. I've got 20% in, other areas that's will bring in a return, but we're not shooting for the star. So
seeking alpha. You're really just seeking alpha, right? You want to beat the market anyway.
Exactly. And that's actually one of the statistics that I actually explain to people when I sit down. I'm like, all right, so alpha is, here's what alpha is. We're trying to produce a better alpha here, bottom line. And that's, to me, that's what it's all about. But also too, having that expectation of the market's going down, there's a variety of measures to kind of take when that happens. One is the obvious thing, is just get them out of those long positions. Right. It crosses a moving average, it crosses a weekly trend line. It breaks demand areas. Hey, why are we sitting long in 60% of our portfolio? Why do that? On the converse side, obviously going long volatility when the market's going down, that's another hedge, right? You can hedge with volatility. I haven't bought into the whole sector rotation yet. I guess that's just, again, the whole anti-establishment, investor type mentality.
Sure. But it's funny. I'm glad you say that, because it's not like I've thrown it out. Like there absolutely is something to rotation of assets, and you can see the money flow. But I think that the more that people follow these types of models, the more we start to see the whole model. It shifts, right? So what used to be like at the peak during a bull market is now all of a sudden, well, that's actually as we're going into a bear market now. And I think that that's always our job, me as an individual trader, to look at the markets and say, hey, how are these dynamics, these historical relationships of connectivity working, or are they shifting? And you as an advisor, in managing people's money, this is something I think it's got to be pretty important for you, because we have these legacy models, Santa Claus rallies, and all that type of stuff that you probably adhere to and your clients listen to. It all works until it doesn't. And I guess the big thing for me, because I'm managing much less money than you are, is if I'm wrong, I just have to say I'm wrong and I move on. I think with clients, it's got to be a lot more difficult, because they're each going to be different.
Yeah, it is difficult. And that's why, again, using options, most of my clients aren't going to really understand really what the options are, and it doesn't really matter. But, another really good way is just getting the delta, just reducing the delta using the puts, whether it's just straight buying puts, or I'm working with Corey Lane over at Trader's Army. He's, nice. Because I've traded options for, 7-8 years, but never at the level and the understanding with what as somebody like him. But he has me looking at back ratio put spreads, which that makes a lot of sense from an investing standpoint. So sure. I've got to think bigger. I've got to think bigger picture, and I've got to think bigger moves. So if I can get the delta to 5 to 10 delta in a portfolio, because I think I got to give kudos to Thinkorswim. They have this amazing, you can put your whole portfolio in TD Ameritrade or Thinkorswim and actually beta weight it, and then you can basically see, all right, if I buy X amount of puts on the SPYs or the Qs,
here's the impact.
Yeah, it's freaking amazing. So just doing stuff like that under the radar, as long as the market just doesn't stay where it is, we're good. So.
What, as someone who's, obviously you're not in the day trading category anymore, but as someone who's looking kind of that longer term picture, we are in a market situation like today, the Russell, for me, closed below a fairly key level, and we see some of these other market indexes. What sort of things are you looking at where you're like, okay, I'm now going to either get out of these long positions and potentially start buying some puts as a hedge? What are the triggers that you look for? What's
funny is that I and I still day trade, by the way, but I never, ever, ever, ever looked at any real indicators unless it was on kind of like a bigger picture time frame. But I never looked at any indicators until I started kind of doing, managing money. And I really find, like kind of the weekly and the daily moving averages, like the 20 and the 50, those are such good trigger points, right? If we're closing below the 20 on the weekly, now it's maybe time to get out of, a certain long positions or reduce the long positions.
Mm-hmm.
Those are great triggers. Even trend lines, I always use trend lines and I always use trends and supply and demand zones. But, what I'm finding on the institutional side is that, you could be at a nice little demand zone, and it could wick you out. And where I was as an individual trader, I'd get stopped out, but then I could just sit there and be like, oh, okay, well, now this is getting a little bit more bullish. Let's get back in. You can't do that on the institutional side. So, having those triggers, like, I like the moving averages, like, the combination of moving averages, demand zones, and the trend lines. It just basically just reducing back your exposure as you do that. And again, that's where the options really help as well. So
yeah. Interesting question here from Jason Mize is, what's a good author on options? I'll be honest, Jason, reading a book on options is like reading a book on sex. It's really hard to figure out until you actually get out there and do it. So I would move on from the books. I mean, Larry, if you want to buy a book, Larry McMillan is probably one of the legacy guys in the option space. There's a lot of good authors out there. But, Justin just mentioned, Corey Lane. I've had him on the program many times. I mean, that guy will show you in 10 minutes what reading 5 1,000-page books will get you. I mean, you just watch the videos. Go to my YouTube channel under TraderMerlin and just type in Corey Lane, and you'll see he's pretty gifted. I've had a bunch of different options guys. You can look at Larry Jacobson's been on here, Tim Blotzer's been on here. We've got a bunch of option shows where you'll learn way more in those simple little videos than you would reading any book. So it takes too long.
I've got to echo that, by the way, Merlin. I mean, just having the privilege of being able to have Corey as a friend and just sitting down with him. I mean, I understand options. I know options. Just sitting down with him for 5 minutes, I'm like,
yep. Bro, that's every time I have him on the show. Every time I have him on the show, I'm the same way. I'm like, oh, wow, damn.
Where am I? Wait, I'm in the wrong room here.
Yeah. No, Dwight Traderman is he's not here today. This is Justin Krebs on the show today.
We look a lot alike.
You do. Big Eb says, get them into DWAC, the Donald Trump SPAC one. I was bringing the chart up here as a joke for everybody, but you can see the DWAC, DWAC. So, I'm pretty sure Justin's not getting his clients in this one, but you never know. For all the viewers out there, you heard him say something that I wanted to share with you just so you can see where we are, because I agree. I think that technical indicators for me, for the most part, are problematic because they become this addiction. They become this crutch, and you force yourself to follow the indicator, not what price is telling you. He mentioned, look, if you get a weekly close below the 20-period moving average, it's not like this is the end all. It's a line in the sand where you say, okay, now my perspective of this market may change. So take a peek at the current indexes. Here's the Dow Jones Industrial Average on a weekly. You notice today, some would say we closed right at it. I would argue we closed just below the 20-period moving average. Your S&P 500 is literally dead on that 20-period moving average on the weekly here. You look at NASDAQ. We are below that for the past 2 weeks. Actually, 3 weeks we've been below that 20-period moving average. And then you look at the Russell 2000, which just about 3 weeks ago as well broke below that 20-period moving average back in November, which some people say the Russell's that canary in the coal mine. Kind of interesting that one broke below the 20s so long ago. It's actually below its 50 as well. So wanted to show you that because so many people are looking for the market to roll over. This is one of those signs that I follow as well. And it's just one more checkbox, right? So you can line up all these different factors to say, hey, the markets are going to be going down. All right, below its 20-period moving average. Check in that category. That starts to weight the discussion a little bit more towards, again, liquefying long positions or hedging those, protecting those, maybe selling some options to protect those portfolios. Or if you're like me, let's start going short, right? That's my perspective on it.
Yeah.
Your dad didn't give you the birds and bees and call and put options talk. No, my father didn't do that one. It would have been funny though if he did. All right, so we're in that position right now. Do you look at things like, I guess, somewhat like sector rotation? I mean, right now there's some sectors which are just absolutely just blowing apart the market, looking great. And you look at financials. I'll bring up some of them here in a second for the viewers at home. But is that part of your analysis as well? Is saying, hey, look, this is one of the stronger market segments as we speak. So for like example, here's financials. You got 2 weeks of weakness, but mostly doing pretty well. Energy has just been absolutely ripping to the upside. And you look at something that's the weakest on the year so far is IWM, right, which has been selling off. How does that play into your analysis or allocation?
Yeah, I mean, it's as far as the model is concerned, I don't do much of the sector rotation because again, I'm very heavily a technical guy.
Yep.
With the fundamentals mixed in, right? So yeah, does my portfolio have some energy and some financials in there right now? Yeah. Does it also still have some tech? But the tech's getting crushed right now. So I mean, that's kind of the balance, right? But yeah, I mean, you've got to weigh in on the longer time frame, on the longer aspect of it. You've got to blend in the fundamentals. I mean, everybody's kind of, I think, I had a client ask me just yesterday. They're like, should we expect a good return for first quarter? And I'm like, honestly, the first quarter is looking like it might be a bit rough. It might be a high volatility quarter. But overall, you've got to think you're still bullish overall in the stock market, even despite, and because they bring up, well, what about rates? Well, again, this is the fundamentalist talking here, which never would have been. I never would have uttered this like a few years ago. But I mean, statistically speaking, yeah, I mean, stocks is a good inflationary hedge, right? So what happens is if we do have raise rates, yeah, all the short-term traders are gonna be like, oh no, this is bad, but it's overall statistically it's a good thing when it comes to the stock market. So you've got to consider that. As long as I'm not technically broken on the bullish uptrend, I still have that bullish play. You've got to go to it for right now.
Yeah, like the old phrase, everything works until it doesn't. And I'm in that camp. The viewers that watch the show know that, was it 20? I think it was 2020. I put on a monster short position. Like it was just ridiculously large. And unfortunately, that one just didn't pan out. I was wrong, took my lumps. And I had to find risk. I knew what I was risking on that one. And I took it like a man, right? You got done. But at some point, I'll get back to that where the market is giving me all the right signals and saying, hey, that long trend that you've been talking about, that bullish market, which we've been enjoying for a decade, it'll turn. And, my question to the vast majority of people here, not necessarily the viewers, because I think you guys are much more astute than the normal average American, is we can all sustain a 10-year bull market rally. I mean, everybody wants it. It's easy. You don't do anything. You just buy and hold, right? But how many people could sustain a 10-year bear market? And I don't think it ever lasts 10 years, but it's a hypothetical. What if we go into this economic malaise and all of a sudden, we have to redefine how we do things and how we approach these markets, and hopefully we'll be short. I know you can't really short too much yet, but get the insurance there and you can.
Well, I mean, if you really think about it, all the big boys, BlackRock, what was the other?
Goldman, BlackRock, JP Morgan, all of you guys.
They're all their predictions for the next 20, 30 years is an average return of no better than 6% per year. No better. So, I mean, I think one of them had like 3%. I'm like, holy crap.
Wow. I'll just buy CDs.
Could you imagine if we went to that? And interest rates are still low. You're not getting anything from anywhere. I mean, yeah.
But that's the beauty of it, though, right? I mean, that's really why we do this, is to say, how do I seek alpha? If the S&P is getting me 3% and I got 4%, I still feel like I'm winning. Of course, right now we're in a situation where you got to be beating 7% just to beat inflation. Yeah. Right. So add that little wrinkle into it as well.
But the inflation's going up because obviously we're having the negative inflation readings coming off, the back end, which it's going to do that because we have 2 or 3 more negative readings that are definitely going to come off. So inflation is you're going to see the number print higher, even if arguably, whatever you believe about inflation, the number is going to go higher.
Yeah.
And that's why I think the short term investors are going to look at this as a bad thing. But
I think any investor needs to look at it as a good thing. As long as you position right, who cares what the time frame is?
Yeah.
So Margaret who would like to know this one. This is something I think they ask every guest on the show, and it has been a while since we had you on. I have to ask Justin the obligatory: do you trade crypto?
I get that. I probably get that from just about every client.
It's the hottest topic in the world right now.
I mean, for the purposes of this, no, definitely not. I mean, it's not that I'm against crypto at all. I mean, I think it's I saw a commercial the other day. The guy was investing in crypto and he was like, "Hey, I'm a millionaire." The next day, I'm not a millionaire. Exactly. Hey, I'm a millionaire. So I think it's a great vehicle to trade. I don't think it's a great vehicle to yet include into an investment strategy for somebody entering into their twilight years and wanting more dependable returns.
Just correct me if I'm wrong here, but I get the feeling personally that I think that you probably would. Like, okay, someone's in their 50s, 60s, and you're like, oh, we can do that. Let's do a small, 1 or 2% in a Bitcoin or something, maybe.
Yeah.
I'm guessing that part of the reason that you're saying no to it is because this is an unregulated asset class. And I think that if you were to be putting your clients' money into crypto and something were to happen, it opens the door for litigation and somebody to go, my advisor sucks. He screwed me by putting me in crypto. And to me, that's why I think most advisors are just going hands off until we get regulation.
Exactly. And honestly, you can't even, sometimes you can't even get into instruments that have anything to do with crypto. You just can't. It's, whoever your custodians are and stuff like that, sometimes they won't even permit it. It's legitimately that issue. So anytime anybody ever asks me, I'm like, hey, take money that you can lose and you want to invest it on your own, that's fine.
Yeah. Nice. Hey, I love the honesty and the transparency. So as we roll into, obviously it's January. We got a few weeks under our belt here in 2022. What is your hypothesis? I know that you like to look at the big picture. You're a macro kind of guy. I'm sure there's got to be a smattering of fundamentals that you put on there, such as the rising interest rates or the macroeconomics like GDP numbers, et cetera. What sort of things are you looking at, and what's your hypothesis for this year? I did, by the way, do a survey. So I'll ask you at the end, what's your target for the S&P by December 31st of this year, just for fun? Now you're on the spot.
Yeah.
You don't have to answer it. I get it.
No, I think, I hate to say this because for years I've been thinking that the market is well overvalued, and it completely is. Everything about the market is in a dangerous territory, but again, if bond yields are rising, we've got a ways to go for bond yields to rise until they get to the valuation of where the stock market really should be. So with that in mind, you've got to assume that as long as we maintain the technical aspect of this market trend, as long as we maintain the bullishness of it, 2022 should be a bullish year, given that. But if again we break down, if we break some of these significant weekly upward trend, or we break some significant support, we're heading down, and we're heading down in a massive way, I think. So,
man, you got to be careful what you say there, buddy. That almost exact statement's what got me kicked off CNBC. I said, break out the bulldozers, we're going down in a big way, and I got booted from CNBC. Don't worry, I'll have you back on the show. I'm not that petty.
Yeah.
So you don't have a forecast. You're just like, hey, what happens. I've got trigger points. If it goes down, great.
Yeah, I've always traded like that too. I don't have any real. I've never had an expectation. I've never tried to say, hey, it's going to be here, it's going to be there. It's just, hey, if it's above here, I'm long. It's below here, I'm short. I'm out. On the investment side. So, I think we're tentatively bullish. I think the first quarter is going to be a high volatility struggle. But if we get past the first quarter and we haven't broken the upward trend line, or haven't broken any major support or demand, in the S&P, I think you're going to see probably a positive year, maybe in the 8 to 10% range.
Well, all right. So the viewers out at home, I read this article today actually by a guy named Ned Davis Research, which I thought was interesting, and I guess it's a trust but verify type of situation. But what percentage? And it's all guessing for most of you. I just thought you might find this interesting. What percentage of the NASDAQ stocks are down 50% or more off the peak? Any guesses for the viewers out there? I mean, there's a 30-second delay, but this was pretty surprising to me. So what percentage of NASDAQ stocks are down over 50% off of their highs? You got any guesses, Justin?
Wow, that is a good question.
Right? It's funny.
I would say 15 to 20%.
All right, well, let's see if the viewer. We'll see the delay come through. It's 33%.
Wow.
Right? I was like, wow. You look at this market all-time highs, and it really makes you wonder. And again, guys, it has all to do with the way these indexes are constructed. Right? Right now, you've got most of the value of the Nasdaq, for example, is in Amazon and Apple and Google and Microsoft and Facebook. That is the vast majority of weighting. But remember, there's a lot of other companies in there, and over a third. It's down 50%. Wow, we got a pretty good, actually the audience is saying 25%, 45, 25, 42, 32. Actually, I personally would not have guessed that high. I thought it would actually be less than that, but just goes to show you the power of the few in these markets and these indexes to steer things in the direction they need to go, I guess.
That's crazy.
All right, so let me really quick. I'll bring up your site over here. So for those who want to know more information about Justin, what he does, it's theproactiveinvestor.com. You can check him out by clicking on any of those links. Do you do any classes? Do you do any education? I mean, what kind of things? Newsletters? What kind of stuff can I promote for you?
I mean, I have local classes and stuff like that. But I mean, no, I mean, to me, it all starts with a conversation. So if anybody ever is interested, just call me up or send me an email or go to the website. You could book a time with me or whatever. But I mean, honestly, I think I saw a question from somebody that said, why don't you do managed futures as a CTA instead of the RA? Because I got into this to actually help people with their retirement. All my parents and aunts and uncles, they're all retirement age. So that's the whole purpose of actually doing that, and be able to have the tools that I need to help them, not just on the trading side, but tools that they'll need in retirement. That's why I started the RIA. So.
Yeah, and one thing I'll throw for the audience out here, and this is something that, I mean, regardless of where you keep your money or if you manage it yourself or have someone manage it for you, one thing I always think is an interesting discussion to have with them is, do you actually trade? One thing I got to know Justin not because of his money management, but because of his education, and he was actually trading, right? He was a very active trader. So when I worked for this financial advisor or financial planning firm when I was younger, nobody there traded. Nobody there traded whatsoever. They were basically being written scripts on what to say and what to promote to clients. And I don't know, I feel like there's almost for a lot of these firms, maybe a disingenuous attitude towards their clients. It's just saying, as long as I have assets under management, I can feed them whatever they need to hear, and I'll make money off commissions. And one thing I respect about Justin is it's not that way. I mean, he is a trader. He has perceptions of the market from a real trader perspective, and a lot of people don't in the financial world. So props to your differentiation.
Well, I mean, you got to do it. You got to be honest. I mean, you and I both know the value of honesty in this business.
Should we start talking about our favorite trader out of Chicago? If you want, he's starting up a new financial firm. It's called Lie, Cheat, and Steal. It's going to be awesome. Sorry, too soon? My bad, everybody.
LCS, I like that.
Yeah. Yeah, that is pretty good. LCS Money Management. Maybe we should suggest that for him. Anyway. All right. Anything else you want to throw in there? I mean, anything else that you see that's exciting in these marketplace that you think it might be a good topic of discussion?
Well, I did have something. I just literally forgot what it was.
And that will happen. Those senior moments. I see the hairlines receding. Don't worry, mine is too, and it's getting all gray. So, in this, you mentioned a little bit about bond yields. So let's go there until maybe that thought gets spurred again. I have been talking about this for quite some time with Bill Addis, et cetera, looking at these bond yields, and I'm bringing up the 10-year for everybody. The further that this goes, and I have a measuring object drawn on the screen, we really kind of broke out of an ascending triangle here on the 10-year as we speak, literally last couple of days, or actually last couple of weeks, looking stronger and stronger. I personally believe that this is going to continue. I think with the rising rate environment and the tapering ending, we're going to see this spike much sooner. If that does happen, and you can let me know if you think it does, what do you think the impacts might be, and how might somebody play a spike in interest rates?
Well, I mean, that's a fantastic question. I mean, how I've chosen to do it is, I bought some banks, right? I mean, high interest rate environment, banks financials, they do pretty well. So, like for example, KRE. I just liked it just because it's the first three letters of my last name too. So, but,
as long as you don't say it's BS, but I'm dumb.
But I mean, that's performing relatively well because that's one way to play the interest rate environment.
What's real quick? I don't look at CRE, but what would you say is the differentiation between CRE and XLF?
CRE is the regional. CRE's the regional banking. XLF is basically just the financials, the overall financials. So CRE's a little bit more on the regional bank side. So you could play like individual banks, but I didn't want to try to compare the individual banks. So I just bought CRE instead.
Nice. Yep.
Because again, thinking as an individual trader, that can be a completely different decision. But as on the institutional side, I don't want to mess around with a whole bunch of different stocks when I'm managing an overall portfolio. So, CRE was just kind of the ETF that made it a little bit easier for me on that.
Nice. Yeah. It's one of those things where if these rates do continue to spike up, I mean, it's going to put a lot more pressure on the market, but there's always an asset class that's there to capitalize on a rising rate environment. So, especially as someone who's managing money, I know you'll be putting your money in that segment as well.
Yeah. I mean, I got into it as soon as, at the end of last year when the Fed was even hinting at it. So,
nice timing.
I mean, yeah, it's performed well. I mean,
It's funny, Big Eb says people freak out the thought of a 2 to 2.5% of the 10-year quality tech goes on sale by the Big Ebs. Yeah, and by the way, if let me bring up that 10-year. Even if we did get up to 2.5%, this is by no means the end of the world. Where's the 10-year? There it is. Again, this is a weekly. Look where we were. I mean, back in 2018, markets were doing great. Markets are awesome, and we were up at 3.25. So no big deal. It's just what it means is that the cheap, easy money that's been fueling this unbelievable rally, it's starting to go away, and they're gonna have to find other ways to generate income streams. I mean, this market, every time I look at it, I just shake my head and just in dismay at how crazy it has been since 2009. I remember when I was shorting the market aggressively when we hit 1,600. Why? Well, because that was the previous high we saw to the dot-com rally and the financial crisis rally, so shorting the hell out of it. Got smoked on that one. Good thing I'm not holding those short positions.
Yeah.
Would have been a much different outcome. Well, Justin, hey, thank you so much. I appreciate you coming on the program today. It's been 9 months, so hopefully we won't have another child by the time we get you back on this show. But thanks for your insight and your perspectives on the market. Always appreciate it.
Yeah, no worries. And thanks for having me on, as always. I always enjoy talking to you, Merlin.
Well, we'll see if I get you on more frequently. I mean, do you do any newsletters or anything?
I have a newsletter, but it's only for clients only. So, yeah. Right. So, sorry.
Don't worry. Sounds good to me. All right, buddy. Hey, thank you so much. Appreciate it. Have a good one, and congrats on the new child.
Thanks, man. We'll see you. Take care. And congrats on the Niners.
Yes. Congratulate me on February 15th. All right, I'll talk to you later. Take care.
All right. Bye.
Guys, that was Jesse Krebs giving us some perspective on these overall markets, talking about how the bigger picture, I guess not bigger picture, but the investment firms have to focus. I thought it was rather interesting, the apprehension for shorting or crypto even in these portfolios. Remember, depending on the firm, they might be handcuffed with what they can or cannot do. I did see a question. Yes, you can follow him on Twitter as well. I think I have it here. Let me see, just so we can get his name up there. There you go. It's JMK278. JMK278 is his Twitter feed. So you can follow him on Twitter and probably get some insights into he does a picture of a beer bong. You can get insights out of a beer bong, and that's a key one. But yeah, Justin's just a great guy. I had the privilege of working with him at Online Trading Academy many years ago, and just a great guy. And it's interesting looking at somebody who has mastered a specific profession. He was a golfer and moved away from that into other things. And he's just one of those people that just does. If he does something, he's going to do it to the best of his ability. So anyway, great having him on. All right, real quick, let me go and show you some of the stuff that happened today, and then also for what might be happening mañana. Here are some announcements I thought were noteworthy for today. Your economic calendar didn't show too much in the U.S., but there were two numbers that I think really were, kind of the kind of numbers. Empire State Manufacturing Index expected to drop back to 25. Remember, anything above 0 means expansion. So they like to see it in the 50-60 range. We were at 31.9. They're expecting it to drop to 25. So, still positive, but not as great. Came out at negative 0.07. This is obviously, it hasn't been negative for quite some time. So this is not a good sign, especially in a sign when you have markets threatened by the Fed, right? The Fed is obviously threatening the markets by saying we're going to raise rates, and all of a sudden you see manufacturing slow down. This might not be a good sign going forward. And then the other piece here is this TIC long-term purchases. So for those who don't know what this number represents, it represents the amount of bonds and securities that we are buying of foreign countries or foreign countries are buying of us. So when you see a positive number, it means that more foreigners are buying U.S. bonds and equities than we are of foreign ones. Well, we like to see a high number because that means that more money is pouring into the U.S. But look at the jump we had. It was 7.1 billion positive, meaning more money was pouring into the U.S. And they're expecting it to go to 37, meaning a lot more money pouring in. Came out at 137 billion more pouring in. That's a pretty significant number. Now, to me, it's important because this means that so much more money is pouring into the U.S. And I guess that's critical because if the market's going to keep going up, we need more money pouring in, right? We need to have more and more and more to keep fueling this. And that is one catalyst that would help this market continue to upside. So I thought that was interesting. If you looked at the earnings today, last week on the Monday Morning Must Knows, I was talking about the financial earnings, right? We had that one kickoff Friday. Almost everybody beat on earnings and prices were down. Well, look at Goldman Sachs. They had an ugly showing, and this is important because Goldman Sachs is such an expensive stock, and depending on the index, price-weighted stocks can really have a big impact on the markets, and it was over $420. This could, if it has a big sell-off, it could impact the things like the Dow much quicker, which in fact it did today. Dow was down a good amount. They missed by 10% and were down 6.8% on the earnings news. But notice Charles Schwab, they missed earnings, they were down. PNC beat earnings, they were down. Basically, not much was spared here. Transportation showing the little shining light at a gain of 1.83% on a pretty good beat of earnings. Now, no, we already kind of covered that for Ivan. Sorry, Ivan, I didn't read your question directly, but we did talk about kind of how to protect your portfolio. Here is what's happening for tomorrow. Really, for the U.S., you've got two announcements, which are important: building permits and housing starts. And there are 3 housing announcements happening this week. You got 2 tomorrow, and then I think you got one on Thursday and on Friday. So that is the big news for tomorrow. But really, the earnings calendar. To me, you are continuing on with earnings. You have Bank of America. So I'm going to read the financials first. You've got Bank of America, you have Morgan Stanley and U.S. Bancorp, as well as Citizens Financial. But then also some other industry sectors which are interesting. Alcoa reporting earnings. Kinder Morgan, Procter & Gamble, and United Health Group also reporting earnings tomorrow. So hopefully, yes, energy is a good inflation hedge too for a while, right? Justin just posted that in chat. It will be for a while, but again, I'm the firm believer that if you see something drop 50%, nothing will be spared. It will all end up coming down. GS paying big bucks to their peeps. Yeah, I'll tell you what, if you are on the Goldman Sachs bonus calendar, you did pretty well. I mean, those guys make more in bonuses than most people make in an annual salary. It's just unbelievable. Russell down like 17% from the highs too, I believe. Yeah, so let's wrap up with that. I'll show you this. Here's the Russell 2000. And you're right, guys. We have been talking about the yellow box. And I had this line here. It really, in theory, should be at 2100. So let me just drop this all the way down to 2100. But we did close below it today. I mean, technically, we did close below that box. So real interested to see what the follow-through is tomorrow. What I found interesting was the volume. Of course, it's probably rolling into the new futures contract, so that's why volume is very low. But yeah, this is not a good picture. We've been in this yellow box for a long time. We did break above it a few times, but I think that this could be the beginning of the end. I'm actually hoping we get a nice bounce up, because if we do get a bounce up Thursday or Friday, I will be buying a bunch of puts and starting to build a position, because I do think we'll see this market continue to drift down. And we might get some spikes along the way, but I think if you have like a 3-month, 4-month timeline, I think you're going to start to see, now we'll start to see those selling points come into the marketplace. All right, so that was it. Justin Krebs is our guest today. Again, if you want to know more information about what he's up to, or if maybe you just have somebody in your family who's looking for a good advisor, or somebody in the financial area that's not at JP Morgan or Merrill Lynch and actually will speak to you, as opposed to just put you on hold and get to you when they're done with lunch and going golfing with their buddies. Justin Krebs is, it's a smaller shop, and generally you get more response from those. It's theproactiveinvestor.com is the name of his company out there. You can check that one out. Now, for tomorrow's show, I am going to have all psychology. I'm going to have Dr. Woody Johnson on the program. So if you have an issue with trading, if you have an issue with investing or some asset class or some personal issue, do me a favor, email me at TraderMerlin@gmail.com. And if you don't want me to read your name in it, say don't read my name, but most people are fine with it. And let me know what your issues are, right? What are the problems you have with trading? What are some of the obstacles or roadblocks that you feel are in front of you or you keep smacking into? And maybe Dr. Woody or myself can help fix not fix, but at least point you in the right direction on finding solutions to fix those problems. As any trader will tell you, the biggest challenge that we have in the world with trading is ourselves. It's not how to trade the S&P or what strategy we use or tactic or time frame or platform or none of that crap. It's how we react to things, whether that's the thrill of victory, the agony of defeat type of scenario. For me in trading and investing, that was the biggest challenge. And I'm sure for many of you, that still is the biggest challenge, is how do we overcome my fear of live trading or my fear of stop losses or my overzealousness to do things. If you got something there, let me know. Email it at TraderMerlin@gmail.com so I can get those all ready for Dr. Woody Johnson on tomorrow's show. Same time, same channel. If you guys have anything else you want to talk about, you can email me as well, TraderMerlin@gmail.com. Until then, happy trading, and I will see you all mañana. Take care.